Well, good afternoon from New York, everyone. Thank you so much for joining us today for today's LinkedIn Live session. Now, before we get started, I wanted to share a quick disclaimer. Now, this webinar is provided for informational purpose only and is not intended to be financial or investment advice. There are inherent and significant risks involved with trading digital assets. Kevin Yadid Baton is a partner at Parify Capital, and the views presented by Kevin are his own personal views and may not represent the views of Parify. Now, Parify is an investor in Gemini's parent company. And to reiterate, the information provided here today as part of this webinar is not investment advice and should not be construed as such. Now, there's a feature on LinkedIn Live that you can add comments. And of course, you're welcome to leave comments during the event. Unfortunately, just given the setup, we probably won't have time to answer them during the discussion, but we'll certainly follow up with you after. No problem at all. Now, with that out of the way, I wanted to give a quick introduction to myself as well as Kevin, for those of you guys who don't know us. So my name is Claire Ching, and I am the head of Gemini Institutional. I lead and empower a global team of business development professionals to advise institutional clients who are looking to engage in digital asset endeavors. Prior to Gemini, I've spent 12 years on both the buy side at Avenue Capital, as well as the sell side at Deutsche Bank. Now, on to Kevin. So Kevin is a partner and portfolio manager at Parify Capital, which is a leading digital asset investment firm that invests across the blockchain landscape through token, venture, and quantitative strategies. Kevin manages Parify's quantitative strategies and has been one of the earliest institutional users of stablecoin. Now, I guess with that said, Kevin, I'm so curious, when did you first touch your stablecoin and what did you use it for?
Thanks, Claire, and it's good to be here. So our first use of stablecoins is actually quite interesting and goes back to 2019. So in the early days of Parify, we had idle cash in our bank accounts. And at that point, interest rates in the economy were around 2%. So we were earning around 2% on our idle cash. And around that time, I had been playing around with crypto custody. I've been playing around with the concept of private keys, smart contracts, the very early days of wallets and what was called, eventually became called DeFi. And we stumbled across a protocol, this application called Compound Finance, where without really taking much counterparty risk at all, in fact, you were just facing a piece of code, we realized that we could be earning roughly 800 bips higher than what the banks were paying you. So you could go from 2% on your idle cash to 10% without taking price risk and by facing a smart contract. And due to the fact that I had come from both finance and engineering background, we underwrote the Compound protocol in detail and ended up bridging our cash from the traditional finance world over to the crypto world and depositing it in Compound. And that really was our real first use case of stablecoins, and one that kind of continues to be prevalent today.
Definitely, that seems super interesting in terms of the first sort of foray into the market for sure. And I guess throughout the last few years, we've seen a lot of development in the space and different uses for stablecoins, of course. But, and I think that, crypto markets move so fast, right? Like sometimes a month in crypto feels like 6 months in traditional markets. So just to refresh our memories here, I guess, can you actually bring us back to that weekend in March recently where we saw fractures in the stablecoin market?
Yeah, funny enough, when we think about the 1 to 6 months feeling, I was talking to my wife yesterday and basically it was like, hey, as FTX was really 6 months ago, and I was like, yeah, it's kind of been sometimes it felt like yesterday, and that's probably because crypto markets trade 24/7, 365, and when you actually do the math, each month in crypto really is equivalent to 4 months in traditional finance because there's just so many more hours of trading hours. So just as the market had digesting the FTX events from Q4 2022, I think it encountered this new crisis that it really hadn't seen before, and that was the banking crisis, which was somewhat of an exogenous event to crypto specific. It was now crypto facing like a traditional finance crisis. And I think the issues, the cracks in the market really started before that proverbial kind of like weekend in March 12th, March 11th. It started the week before with Silvergate going concern filing, which effectively said that Silvergate may be unable to continue operations. And I think most people maybe joining are familiar with Silvergate, but for those that aren't, Silvergate was kind of like the key banking provider for crypto native trading partners, counterparties, exchanges to bank, to settle transactions via their SEN network, the Silvergate Exchange Network, which effectively allowed a non-wire, non-stablecoin way to settle trades and move money around. And shortly after the going concern filing, 24 hours later, the SEN network was halted. So now fast forward to a week, you no longer have Silvergate, you no longer have SEN. And on Friday, you basically kind of head into this scenario where Silicon Valley Bank gets shut down by regulators, followed by Signature Bank on Sunday. And during that period, if you kind of think about what is the worst possible time to shut down a bank that has a crypto component, it's probably on a Friday night. And that's because the bank stops, but the blockchain keeps on running. And whenever you kind of have a fragmentation in like one time scale versus the other, in other words, two markets running at different speeds, in fact, one was completely paused, one kept running, you had fragmentations in prices. And that's kind of what we saw. We probably saw the biggest dislocations in stablecoin prices, primarily for two reasons. One, Circle, which is the issuer of USDC, one of the primary stablecoins people use. First, it was kind of speculation that there was a large portion of the reserves stuck at Silicon Valley Bank. On Saturday, they announced that it was roughly around $3 billion of their reserves kind of stuck in Silicon Valley Bank. And what was interesting though was that the market acted irrationally because it forgot that stablecoins have two purposes. One is that they can be traded on the secondary market, and the other aspect was that they can be redeemed and created. So following the announcement that Circle had exposure to Silicon Valley Bank, you saw one of the most institutionally loved stablecoins, USDC, trade to as low as 85 cents in some exchanges. And Tether, USDT, one of the, from the institutional world, one of the kind of like stablecoins that's typically most perceived to be the riskiest, trade at roughly 10% premium to its par value. So you saw these tremendous dislocations in the value of stablecoins, and other stablecoins like the Gemini dollar and DAI kind of experienced volatility around the $1 peg. And I think people really kind of came to realize that the secondary market prices matter, and that stablecoins really are only as good as you're able to redeem them.
Yeah, I mean, certainly fascinating sort of unfolding of events, I guess. What do you think in terms of like the market's perception of like the risk profiles of stablecoins? Like, how did that change thereafter?
I like to say that stablecoins may be worth one, but may not always trade at one. And I think that was certainly true in the Silicon Valley banking crisis. So in my experience, stablecoins really kind of resemble credit instruments, meaning that their true value of them is somewhat dependent on the credit worthiness of the issuer. And if the credit worthiness of the issuer becomes kind of a going concern, well, you should expect those stablecoins to kind of begin trading below par value, face value, similar to like what a bond would do. Because ultimately, at the end of the day, if you have a stablecoin, sure, you can trade on the secondary market, but they're only as good as their redeemability. Can you show up to the issuer and say, I have $1 stablecoin, I need $1 back? That's ultimately kind of, I think, the ultimate test. And as a thought experiment that I like to ask myself is, if I have an empty box and I put $1 million of cash in that empty box, and I close it and I hand it to you, Claire, and I say, here is a box with $1 million, and it's yours, but there's a catch. You never get to open the box. The money is forever locked. And I proceed by asking you, well, what is the box worth? What's the value of the box? Is it $1 million? Is it less? Is it more? Is it zero? And I think those kind of questions are kind of like, intellectually interesting, because it really kind of comes to show you that while there can be a secondary market for trading stablecoins that is dependent on exchanges or on blockchain protocols, ultimately, I think at the end of the day, you want to be able to ensure that you have access to creation and redemption facilities for stablecoins. So, for example, like in the case of USDC, it can be created and redeemed in Coinbase and Circle primarily. In the case of Gemini Dollar, it can be converted and redeemed in Gemini Exchange. In the case of USDT Tether, for example, the average person doesn't really have access to creating and redeeming Tether. You are completely dependent on the secondary market. And that's why we saw such large deviations in the market that weekend, with Tether trading roughly 10% higher, because of the fact that people were unable to take Tether and just cash it back for dollars. So what the banking crisis kind of like really highlighted was that in addition to having access to multiple market venues to trade stablecoins, one versus the other, institutions better have diversified and multiple avenues to create and redeem stablecoins. As a data point, during that weekend of the banking crisis, because Circle paused redemptions and creations of USDC, and people wanted to exit, they had two options. They could either sell it at a 15% discount to what they pay, which is a ginormous discount, assuming that you think something was going to be worth $1. So what they ended up doing is they fled to protocols like MakerDAO, where they could swap $1 of USDC for $1 for one unit of USDC for 1 unit of GUSDC and Gemini Dollar, and taking it to the Gemini exchange to get cash out. So we saw during that period roughly $150 million of Gemini Dollar flows as a kind of this flight to safety from institutions that wanted to not have that underlying risk to Silicon Valley Bank during those 3 days in the weekend.
Right, exactly. And I guess like just on the topic of that, I mean, you mentioned a few stable coins there. Did you want to touch upon sort of the history of like a few other stable coins, the type of experiments that people have gone through in terms of like constructing those? Yeah.
Well, like stable coins, people sometimes say, hey, why do you need a new stable coin? And I think it really kind of comes down to the fact that not all stable coins are alike, even if they're dollar stable coins. Why? Because they may have different issuers, they may have different smart contracts, they may have different banks, different blockchains that they're operating on. So while stable coins have kind of been this great invention of crypto, and for better or for worse, with great successes like USDC, for example, and Gemini and DAI, you've also seen great failures. Like Terra Luna and other algorithmic stablecoins that just couldn't get the models right and ended up imploding. So when you really kind of underwrite a stablecoin, you have to underwrite not just the token itself. You really are underwriting 3 to 5 layers of underlying technology and financial infrastructure, starting really at the bedrock of the US government, because ultimately these are US-based stablecoins and they're tracking the dollar. They need to have some exposure to dollars. And I'll come back to that in a second. So, you have the US government, you have the banking institutions, you have the trust companies, you have the stablecoin issuers themselves, the blockchains, the smart contracts. So there's this nested layering of financial and technological infrastructure that needs to come together perfectly to permit the use of stablecoins. So really, not all stablecoins are alike, and And one more other thing that I'll add, for example, is, which I think the market doesn't maybe appreciate sometimes as well, is even if you have two stable coins, let's take the three stable coins, USDC, the Gemini dollar, and Tether.
Mhm.
And you ask, well, they're all dollar-based stable coins. Why do I need to diversify?
Right.
I feel like one thing that is often missed by the market is that even if they're stable coins, their composition can be completely different from one another. Their treasury management teams could take different approaches. And one example that actually is relevant recently, back in June, was around the debt ceiling. So most of the stablecoin issuers tend to take their reserves and invest them in super short-term treasuries to generate yield for the benefit of the enterprise, effectively.
Right.
And right around the debt ceiling events, in the looming kind of U.S. default, Circle kind of publicly took action and divested away from short-term treasuries and kind of like repositioned some of its reserves into like the overnight repo reserves. And by the way, I think like the treasury team, the treasury is managed by like BlackRock, whereas, for example, someone like Gemini, to my understanding, you guys took a different approach. You guys did a barbell approach around treasury. So you removed exposure from the maturities that were around the debt ceiling kind of default deadline, and layered them out to different maturities, therefore kind of like reducing any exposure to any potential kind of like debt ceiling default. But you look at something like Tether, for example, kind of like in the opposite side of the spectrum, and you have Tether with 5% allocation to precious metals, allocations to loans, to Bitcoin. So you have such different underlying compositions in the stable coins that it really kind of comes to the question is like, do you understand what the composition of the stable coins is? That's the first thing. The second thing is, do you understand what the treasury management policy of the stable coins is? Not just where they're held, but how they're actually being managed, because interest rates are doing funky things to markets. And lastly, do you have the right infrastructure to redeem and create stablecoins at times of crisis? And I think that is something that some people maybe haven't been paying too much attention to prior to the banking crisis.
Yeah, absolutely. I mean, it's certainly not a like set it and forget it type of situation by any means. It's a very fluid, dynamic management. Certainly, I guess like in light of that, I think, looking at the market and sort of just overall market participants, right? Like, how do you think has been sort of like the shift in market participants, like use of stablecoins and the overall activity in that, like, in recent months or quarters, in your opinion?
I think we've kind of undergone this like paradigm shift, for lack of a better word, where from early 2019 all the way up to like early 2022, you had this intrinsic arbitrage where interest rates in the crypto ecosystem were higher than the traditional economy. So there was this natural incentive to take dollars out from the traditional economy and bridge them over to the crypto world to capture those yields. And I just want to make a point there, which is when I talk about like high yields, I think some people may interpret this as like, the kind of like classic yield farming phenomenon that we saw. But I'm not really even referring to that. I'm actually talking about like structurally, there was higher yields, there was a higher cost of capital because of the opportunity, like the market neutral opportunities that existed. Right. So you had things like the basis trades, you had things like the GBTC premium, that was a very popular trade. And all of those kind of created this natural demand for dollars that created a structural reason for that elevated risk premium in interest rates. Now, second half of 2022, that you kind of enter a new regime, and that regime was Fed funds rates are exceeding 5%, and crypto rates are low single digits in some cases. So you now have the arbitrage going the other way. where people are not really have no incentive to take dollars from the traditional economy and into crypto because they're earning a lower rate. So then the question is, what do you do with stablecoins? Absent any new crypto native banking provider like Silvergate, like Signature, stablecoins, I think today serve two main purposes. One is 24/7, 365 settlement. And that is something that no bank today is able to offer. So they continue to have, stablecoins kind of continue to have this natural, very sticky role to settle trades in an institutional fashion across counterparties. If you're trading on the weekends, 24/7, 365. The other component that the market has been trying to figure out is, if the government's paying you 5% plus in the short term end of the curve, and you're risk free, and you're not really earning much of that in crypto, how can you bridge that rate over to crypto? So you've seen certain experiments with real world assets and treasuries, bringing US treasuries on chain to allow people to use stablecoins to capture the natural economy rates without leaving the on-chain ecosystem. And you may ask, why are they not leaving? Well, that can be for structural reasons. Maybe they have a mandate to stay on chain. Maybe they have a mandate to have stablecoins. Maybe they need the ability to trade 24/7, 365. So you've kind of seen that that movement away from stablecoins used for every use case to stablecoins to kind of be very focused around trade settlement as well as yield capture within the crypto ecosystem.
Right. No, absolutely. I mean, perfect. Thank you so much for these insights, Kevin, today. I really appreciate the time. And that's all we have for today, folks. Thanks everyone for attending. If you have any questions or would like to reach out to our team, please feel free to email us at institutionalteam@gemini.com. Thank you.
Thanks, Claire.
Take care, Kevin.